Cool. Okay, we're good to go. Hi everybody. Thank you very much, and welcome to Idea Chat Central New York. My name is Billy Seskovich, and I'll be your host this week. For those of you who are joining us for the first time today, Idea Chat is a webcast hosted by RBD Idea here at Syracuse University. We sit down twice a month with inspiring members of the entrepreneurial community to talk about their work and experiences. In the past, we've covered topics related to startups, tech, design, media, and more. This week, we'll be talking about venture capital and the investment journey of entrepreneurship. Before we bring our guest on board, I want to invite you all to follow us along on Twitter by using the IdeaChatCNY hashtag to send us your questions and comments. And so today we will be talking with Peter Hebert about his work with Lux Capital, a venture capital firm based in Palo Alto and New York City. Peter is a co-founder of Lux Capital and focuses on investments in technology and energy. As founding CEO, he helped build Lux Research into the leading emerging technology research firm. Peter has also worked at Lehman Brothers Equity Research Group. Peter manages Lux Capital's investments in Accelergy, Angstrom Publishing, Ours, Everspin Technologies, G2X Energy, Gridco Systems, Lux Research, Luxterra, Matterport, Cybeam, and Transform. Peter is also an SU alumnus, where he graduated cum laude and as a Chancellor Scholar from the Newhouse School. He was the founding president of Syracuse's first venture organization, the Future Business Leaders and Entrepreneurs Group. Peter also co-founded Young Wall Street, a charitable organization supporting youth-related causes in New York City, and serves as a mentor to Imagine K-12 in Palo Alto. So that's quite a resume. So without further ado, let's get the man of the hour here. How's it going, Peter?
Great. How are you doing, Billy?
Pretty good, pretty good. Having a good Wednesday out here. So thanks again for joining us. And I guess to start, could you just tell us a little bit about your background beyond what I just read off? Like, I guess a summary of how you ended up where you are at Lux.
Sure. So grew up on the East Coast, and by the way, I am now speaking to you from Palo Alto, California, but originally an East Coaster. Grew up just outside New York in Connecticut, and actually for most of my life wanted to be a journalist, which is what first brought me to Syracuse. So midway through my time at Syracuse, I realized that journalism and communications was not necessarily what I wanted to do. It was first a class in entrepreneurship that I took through the management school that led me to the conclusion that I wanted to become an entrepreneur. And I didn't know exactly what that meant. I knew it involved starting companies. I knew that there probably wasn't a major that would incorporate all the things that I would need to learn. But that is really what I did. And so I ultimately started taking classes at the business school, graduated from Newhouse in communications. But after that, really wanted to get some sort of foundation in kind of entrepreneurial finance and finance in general. And so I started working at Lehman Brothers, which, much to my surprise, my firm now, Lux Capital, has outlasted and outlived. But never would have imagined that then starting out. So, ambitious, naive, left basically after a year in 2000 and started Lux Capital. And we are a venture capital firm that today, headquartered in New York, now as of 3 years ago, another major office in Palo Alto, 15 investment professionals, manage around $350 million, and focused on backing early stage entrepreneurs and technologists and scientists in one of three areas. Those are both kind of core technology, as well as healthcare and life sciences, and also energy technology. I myself am really kind of more focused on the core technology and energy side, but collectively as a group, really we focus on a number of different things and really technologies at the edges of a variety of disciplines. So that is what I'm doing now, and it's a fun job, extremely challenging, but I'm happy to share more about that.
Yeah, definitely. Great story. I guess, so before we get into some of your daily work with Lux, you touched upon a point that I really wanted to address a little bit, which is your background coming to Syracuse and studying at Newhouse. So you talked about how you wanted to be a journalist, but you decided to refocus into the entrepreneurship path. What were some of the key takeaways you got out of Newhouse, though? Were there any specific either classes, professors, or skills you took away from that training, even though it's not necessarily the profession you went into?
So, I mean, I think there are a lot of general lessons and overall learning that were applicable in any kind of career that you go into. But a lot of the things that you do as a journalist, I think, are immediately applicable in terms of having curiosity, digging into things, analyzing opportunities, and analyzing certainly news flow. So, you know, the kind of the training that I received, the education I received, I have found to be extremely valuable. And this is not just the traditional Syracuse talking points, but the reality is, you know, I have a lot of colleagues and coworkers who came from either deeper finance background or, in many cases, PhD and master's level technology and science.
Mm-hmm.
And the reality is, I think when you're in a job like I have, where you're analyzing people and you're making judgments and decisions based upon your read of situations, certainly Newhouse was exceptionally valuable, but Syracuse in general I found to be hugely instrumental.
Great. Well, I'm really glad to hear that you were able to take away such positive things there. A question that I think a lot of people have regarding the venture side is, what are some of the items that you look at when bringing on new companies and deciding to invest in them? Do you have a checklist, or do you have a standard process you go through? What's kind of the routine?
It's a good question, and candidly, it's evolved over time. I think when we went into it, 14, almost 15 years ago now, we were very much focused on checklists. You know, what are the things that ultimately all of the most successful companies have in common? And candidly, I think throughout that period of time, we've realized that there are certainly things that you look for, and most of what we do is really pattern recognition. So we're trying to identify certain phenotypes of entrepreneurs or founders that we think will be much more successful. But often it's one of several things that gets us really excited, enthusiastic about funding a new company. So in fact, today, before this call, 2 different teams of entrepreneurs came in, very different spaces and industries. But in an hour-long presentation, and there had been several meetings with several of the other team members at Lux before, we made the decision to invest. Of course, not necessarily informing the entrepreneur during that meeting, but it was clear based on a number of questions, the grasp of the market, them as individuals were looking at basically career trajectory. They were really both first-time entrepreneurs themselves. They had experience at well-known startups before. But it's very much pattern matching, where we find a team member and we say, do we believe this person could go out there and sell other employees and kind of co-founders to join the company? Do we think they could go out there and attract great customers and partners? And then also for future rounds of financing, do we think that they, what they're selling is so exciting that they could convince other investors to come in at a higher price? And so, again, those are all things that we have no longer formalized as an actual checklist, but constantly just the questions that we're asking to better understand the perspective of the entrepreneur, we're always looking for before making the decision to back with the fund's capital an entrepreneur.
Awesome. So it sounds like some really important criteria are definitely an understanding of the market and the team's ability to attack that appropriately. And I'm sure it takes experience to be able to understand how to identify that. That's something that isn't exactly written in a textbook. So building off of that, and this is a question actually coming from a member viewing online, Sarah. At another side, what is more common mistakes that you see teams or startups make that kind of make you shy away from investing? Or even after investing, something that causes issues?
Well, yeah, I mean, the reality is there are more things that can go wrong than not with the startup. I mean, the probabilities, are against you. It's really, success is a minority of the overall opportunities that certainly are funded, but even the ones that are of course, started. So people talk about 90% of restaurants failing. I think it's probably a much larger percentage of that for new ventures that get off the ground. Things that people make mistakes, and it's not necessarily mistakes. It's things that we believe more sophisticated entrepreneurs are not doing. Really, one is kind of developing a plan in absence of understanding the market and speaking to customers. So, we often see people that, whether they're scientists, technologists, or just candidly entrepreneurs, think that they have a great idea. They've persuaded themselves of that, and they're going out there, and you need to test that hypothesis. If you think that you're baking a cookie and everyone else is going to love it, you generally probably just don't have it yourself and say, oh, people are going to love it. You'll ask someone else. You'll ask a friend. You'll go on the street. You'll go out there, as they say at Stanford in the business school where they're teaching entrepreneurship, get out of the building. But it's critically important that when you have an idea, when you decide you want to launch a company, doesn't mean that everything, everyone's always going to like what you're talking about, but you really need to test your hypothesis, and you need to be flexible and incorporate feedback. So, the first one is to really test that hypothesis by bringing it to friends, other people that aren't related to you, if you want honest criticism, feedback, constructive improvement. And the second is really be willing. You should obviously be passionate about what you're doing, and you shouldn't just be, ready to change something at the drop of a hat. But you should be flexible. And if you keep hearing feedback, you shouldn't just reflexively be defensive and say, no, you don't understand it. You really have to listen to what people are saying. Sometimes it's not really consequential, it's not valuable, but other times it can be hugely valuable. And we've invested in about 50 companies since the fund started. And the vast majority of them that are hugely successful, or successful in fact at all, have in some ways adapted. And what people now talk about, and it's very fashionable in Silicon Valley to talk about pivoting, which really kind of changing your business model. So many companies that when they originally started out, when they pitched to us, when we made the decision and we pulled out our checkbook and wrote and made an investment in the company, what they're doing today is fundamentally different from what they originally set out to. And so if I think of what then that leads to the conclusion as an investor, and certainly if you're an entrepreneur that's pitching to an investor, you want to make sure that you are portraying yourself and that you are in fact adaptive, that you're willing to listen to feedback, that you're able to engage in a conversation, willing to and open to hearing the other side in their opinion. Because the reality is, whatever you're talking about right now, chances are it's not going to be what you're carrying forward if you're going to be a successful company. Yeah. And there have been scores of examples beyond even the ones that I'm just naming that we've had experience with. I mean, for instance, Instagram started as a company called Bourbon, which is more similar to Foursquare, then ultimately pivoted or adapted and evolved into what they became, and ultimately $1 billion outcome. Facebook was originally Face Mash. Obviously, that did significantly change. But time and time and time again, the companies that are now considered these great success stories, if you actually are honest and trace back to how they started, very different from ultimately the product or the company they became.
Yeah, I think that's a really good point. It's something that I've seen talked about as well recently. You mentioned it's kind of a hot idea to being willing to pivot in Silicon Valley, and I've seen it as well. I know that the well-known incubator Y Combinator likes to brag that a lot of their startups that come out of the company are in fact different from when they entered, and they see that as a positive. So it seems like something to look for if you're able to do that. So that was a question from our audience actually, and for those of you just joining us, just a reminder that you can tweet at us with the hashtag IdeaChatCNY. We'd like to join in on the conversation. So turning to your background again, so you worked at Lehman Brothers for some time, and then you founded Lux Capital. What was that process like, and also how did you end up in the domain focus you are at you're at the company now?
So 1999, 2000 was a rare time. Not all that different from today, but it was one of the few times that someone who had no experience within venture capital, had very limited operating experience and work experience as I did, could go out there and raise capital for this new idea. That's not normal. That was a period of time that, frankly, had we waited another year, probably would no longer have been available. But we went out there and kind of foolishly also went out there without even having anyone that was supporting this idea. We left, we quit cold turkey. said we're going to go and do this. And for a period of time, went out there just knocking on doors, trying to meet people, to get connected to capital, but that's not something that I'd probably recommend most other people do. But we were naive, and we wanted to go and do this. And so we had the good fortune of meeting through that process someone that we were not immediately connected to, but just through consistent networking, sharing the story. Ultimately, someone made the connection to a very powerful individual who's one of the world's largest private equity investors.
Okay.
And so he effectively put us in business, seeded our company, and provided us with the funds to start making initial investments. And that, for most entrepreneurs that are just getting started, the reality is you obviously have to put yourself in the position to take advantage of it, but it really comes down to just serendipity and luck and good timing. And so, again, you can't just sit in sweatpants at home and wait for something like that just to get a call. But you probably, it would be difficult to ascertain before in advance who is going to give you that break. You just need to go out there and hustle. And so we got that break, and basically for the last 13 and 14 years after that have been building upon that. So to your question about how we ultimately got into the space that we are, so when we first started, our vision was really one of going after areas of hard technology, physical sciences, things that other people were not looking at. Why? Because the reality is if we were doing something that everyone else is doing, then there'd be no purpose for us to exist.
Exactly.
So when we first launched, this individual, the private equity investor who put us in business, said, one, this is in 2000, of course, why does the world need another venture firm? And there were 1,000 at that point in time. We said, great question. We have this great answer. We're focused on deep technology, yada, yada, yada. And he goes, okay, so let's just assume that premise is true and you're focusing on something that's really interesting. What's to prevent the rest of the very well-funded, venture firms that have been in existence for 30 or 40 years from coming in there and eating your lunch? And so really for the next several years after that, that is what we focused on, competitive advantage. Why would a great entrepreneur come to little old Lux Capital versus some of the long-standing decorated names like Sequoia Capital and Kleiner Perkins? And so we went out and built a number of strategic assets and entities to make sure that, beyond us being extroverted, good-natured people that were trying to be as helpful as possible and hustling around, that there would be a reason for them to come into Lux. And that ultimately was successful, but it was really making sure that we were focused on a number of very specific niche technologies, including material science and nanotechnology, before broadening then that mandate out to include really emerging technologies among a number of areas. But even today, what we're not doing is focusing on what most of the people that are, if I walked outside of our offices here in Palo Alto, are probably pitching at a neighborhood coffee shop, which would be social, local, consumer internet. We're not doing that. One, because we're not as excited by some of those areas, but also more importantly is we don't have an edge. So if we don't have an edge, then by definition, you shouldn't be giving us money to invest in those spaces. And candidly, as an entrepreneur, you shouldn't be taking our money.
Yeah. So that actually transitions great into a question we got from another audience member, Mike Smith, down in New York. And so he asks, what are some emerging sectors or companies you're excited about today? It sounds like you kind of defined Lux's mission by focusing on those areas other people aren't. So what are some of those areas right now?
So, hello, Mike. It is a great question, and I'm going to give you a couple answers. And some of these are somewhat related. What we found is when you're operating on the edges of a number of different sectors, the reality is you are able to see a view of the world that you wouldn't have otherwise seen had you just been focused on one particular sector. Because some of these technologies are bleeding into one another and enabling other industries to be created. So probably the three most exciting areas which have some overlap, first would be robotics. So we're exceptionally excited right now about robotics. First for applications in areas of surgical robotics and medical fields where we're invested. But actually most interesting to us is what's happening right now with UAVs and drones. So, one of our entrepreneurs, the co-founder of iRobot, Helen Greiner, calls UAVs and drones flying robots, which in fact they are. They're basically autonomous systems that have the ability to fly around, and you can do a lot of interesting things with that. So that would be one and two: robotics, then UAVs, drones, which are very closely related. And the third, which is somewhat of an extension of the second, is imagine that you have eyes in the sky, whether it's UAVs and drones or also whether it's satellites we're invested in. What can you do now if you have amazing imagery of the world? And the reality is, for us, what we find really, really exciting, and frankly, the next generation of data and analytics is going to be a space that I would generally call aerial and earth imaging and analytics. And this is where you're capturing satellite imagery, you are capturing imagery coming from drones, you're combining that with publicly available data sets, and you're able to then do predictive analytics. So you can say, here is what this particular crop output has looked like over the past several days and the past couple months and years, thereby we think it will look like this tomorrow in the future. It's being able to say on a daily basis how many cars are in the parking lot of a Walmart versus a Lowe's or a Home Depot in a particular area. It's being able to, on a minute-by-minute basis, track how many ships are in the port of Singapore versus the port of Long Beach. So all these are able to discern basically the heartbeat of the global economy, which has huge impact. There are trillions of dollars that are transacted in physical commerce. People are buying products. They're not buying things online, where right now there's a multi-billion-dollar business of just tracking the breadcrumbs of online transactions in e-commerce. We're talking about the physical world, where there's commodities, there's material goods that are being not only purchased but transferred and shipped, and it's being able to basically have at any given moment the ability to track that and say what is happening in the world. And today, just to wrap this up, if you think about how many trillions of dollars in financial assets and transactions on a daily basis are done based upon things like GDP numbers, consumer sentiment, all this stuff is basically 2 months old, 3 months old in fact, where they're saying, oh, GDP last quarter, and they'll probably release those numbers shortly, is X. But that's telling you something that happened in the past, not what's happening today. So anyway, that is really where we're focused. It's as an input, robotics, UAVs, drones, satellites, but the why is, what does this mean for the world? What does this mean for financial investors, commodity investors, and for the world of Fortune 500 and Global 1000 companies that are making trillions of dollars in decisions on a regular basis based upon those inputs?
Wow, thank you very much for the insight. That was really detailed, and it's cool to hearing about the how so much of that has a very real-time aspect, bringing past work that was much more delayed or information that wasn't as accessible immediately to the present. For another question regarding how people get into the venture field. You talked earlier about how when you and your co-founders got it started, you just were knocking on doors and hustling. But you also mentioned not necessarily the best way to get started, especially today. For people looking to get into venture capital, what would be some tips from your area how to get started?
Also a very good question, and the reality is it's kind of the needle in the haystack field. I mean, candidly, if I hadn't started this, if I hadn't had this very unique time, I struggled to think of what would have been my on-ramp. It's a small field. For as much as people might know some of the titans of the industry like a Mark Andreessen or a John Doerr, the reality is there's probably about 1,000 professionals in the field. Might be undercounting, but the reality is that it's not. As far as active venture firms, you're really looking about 100 to 200 that are putting out more than 5 investments in a given year of kind of substance. There are a bunch of people that are winging small checks around. And so if you think about that, well, how do you get in? Most people probably come in the route of being a prior entrepreneur. So they've started a company, they've had some success, And because of that success, a lot of other newer entrepreneurs, younger entrepreneurs come to them for advice. That then leads them to the position of writing their own checks and making small angel investments. Ultimately, they upsize that into doing larger investments and managing other people's capital. So that's predominantly the way that most investors have made it into the venture capital field. Another way, although less frequent, people that have either kind of financial training or scientific technical experience, they have a PhD, and it's a highly technical field that people are investing in. And in fact, a number of our associates, principals, and partners ultimately came from that path, got a PhD. We were looking at some real deep area of science and technology and found that to be valuable, and they learned a lot. I would say the second most common path, and this is basically about the only three that are, where the vast majority of people are sourced from, having an operational role in a well-known startup. So you are a business development or an engineering executive at Twitter, Google, Facebook, Tesla, etc. You saw something, you saw a hyper-growth company, you were exposed to that. Because of that, you have a lot of friends, a lot of people that want to know you, you have a Rolodex, you know a lot of different entrepreneurs. That is a very valuable role within a venture firm, someone that is connected, someone that has operational experience that can actually tangibly speak to an entrepreneur and tell them, I know what it's like to be in your position, and then ultimately basically curry favor and trust and invest in them. But those are really the three most likely paths, with one being the prior founder and also the prior operator, number three, as the most likely ways to break in.
Gotcha. So it sounds like definitely having an established network and some domain experience will go a long way when considering entering the venture world. And so another question from the audience, and again, as a reminder for those just joining us, if you tweet at us, we'll be happy to include your thoughts. So this comes from Sarah Roche. So she touches on a point that you mentioned earlier. Her question is, I heard that the failure rate for venture firms is similar to that of startups. If that is so, can you talk about why?
So that's not exactly true. It's interesting. Many of the forces that should be relevant for venture firms are not. That are relevant for startups are not relevant for venture firms. Just so everyone understands, I'll give you a quick overview of actually how a venture firm works, and then I'll help you understand then why that's not the case, why things don't flame out quickly like other startups. We invest money on behalf of other people. We invest our own money, but far and away the largest capital comes from other sources: foundations, endowments, so university endowments, pension funds. So all these people that have large amounts of capital that want a return on their money, and also wealthy individuals and families, provide it to groups like ours, and we invest on their behalf. Now, a venture firm operates by charging a management fee on that capital. So if you have a $100 million venture fund, on average it's basically a 2 to 2.5% management fee. So a $100 million fund means every year to fund everyone's salary, the office space, etc., it's about $2 to $2.5 million. And then there's something called carried interest, which is effectively profit sharing, above and beyond the money that you return back to your limited partners, which is the name for a venture firm's investors. We take some portion of that as upside, as incentive to do a great job and deliver above average superior returns. So the reason that venture firms, once in business, don't really resemble the kind of startup failure rate, although there are some failed venture firms out there, is because our funds are committed capital and they're generally 10-year lives. So there is a really long tail when you raise a venture firm, when you raise a venture fund. For the venture firm, you're basically guaranteeing that you're going to be in business for at least some form for 10 years. So, groups that we know that are horrible investors, awful people, horrible investors, if they raise a fund, they're still going to be around in a decade, whether or not the world likes it or not. So the biggest challenge that venture firms have is the initial onset, which is raising that fund. And that's where most people fail. And I would say, It's probably not the same ratio of startups failing to raise capital or staying in business, but when firms ultimately, when it doesn't work out, it's when they go to the market, when they speak to these endowments and pensions, and the response they get back is, thanks, not interested. That's generally where failure occurs. Very seldomly do other firms, once they're operating, unless there's some real explosions or implosions, do you see venture firms themselves go out of business. They kind of quietly just pass away.
Cool. Well, great. Thanks for the insight there. I'm sure Sarah probably found it very helpful. And I guess one last question. So you touch upon, you kind of mentioned earlier that there are some bad investors out there. Is it how for startups looking, to go out there and get funding? What are some tips that you might have on how to find the right firm for you? How do you find the people to trust?
So, the good answer here is that there's far more transparency into the world of venture capital today than there was when I got into the business 15 years ago. When I first entered, the internet was just in its infancy. All these things, all these, venture firms were these cloistered partnerships. You almost prided yourself on not sharing information. Today, some of the most well-known firms and investors have blogs where they're talking about decisions that they're making, challenges that they're making. There's feedback, so you see comment section where people are engaging. There's Twitter, and this is a way to at least see the public persona of the investor. Remember that there are the firms, there's the identity of the firm, and then there's the individuals themselves, which are far more important. So just as you could say, well, Syracuse has a reputation for X, it doesn't mean that the person that happens to go to Syracuse is a good, bad, or other person. It's just there's sometimes that there's an institutional reputation, but more often than not, you're dealing with the person that just happens to be in that organization. So the best way to get connected to other venture firms or, let's say, investors if you're raising capital is probably through the people that they're already investing in. Many of the entrepreneurs are out there. They're actively engaged in the community. They're seeking to network. And so I am always looking for a qualified lead and kind of an introduction from someone that I know and trust, because it's very helpful for me. If I know that a guy that or a woman that we're invested in knows someone really well and speaks very highly of them, then I will take that meeting and I will take that introduction in a very different way and mindset than if someone emails info@luxcapital.com and says, hello, insert name, as we receive pitches every day that sometimes things like that, like hello, Mr. like blank, that's obviously they're emailing 500 other people. So again, it's about really understanding the other person on the other side of the table. Everyone's a person. Everyone has a personality. Everyone has friends, hopefully, in a network. And so being able to kind of get in through that network makes us understand as investors who see a lot of flow, makes you very quickly understand, okay, this is a genuine individual. They're not just emailing me with this interesting opportunity from Nigeria. So to us, a qualified lead is the most important.
So again, I think a big takeaway is making sure you have that network. It can go a long way. Well, Peter, this has been great overall. We've gotten a lot of insight from all different sides of the venture world. And I know we need to wrap up soon, so I just wanted to give you time to just share any last points if you've had anything at all to say before we get going.
I think you have probably done a better job of summarizing my content than myself. I mean, the reality is I think so much of it is about who you know, and it's not necessarily who you know, who your parents know, or it's not something that you're naturally imbued with, but it is critical to build out your network. And even starting from a place where you might not have connections, which candidly was me when I first started, it is really the imperative on you to go out there, meet interesting people, surround yourself with people that are doing interesting things, and just be curious, because I think that will take you in a number of different directions. And whether that's starting a company, whether that's becoming part of a startup that's starting to gain traction, I think you'll be much better off if you actually take the bull by the horns rather than just waiting for some event to occur to you.
Awesome. Well, thanks again for everybody joining us. This is the end of this version of Idea Chat. You can also follow Peter on Twitter via Peter J. Hebert or visit luxcapital.com to learn more about his firm's work. And you can join us next time, November 5th. We're going to be chatting with Matt Wilson of Under 30 CEO. In the meantime, feel free to tweet at us still with Idea Chat CNY to join the conversation. Peter, thanks again so much. This has been great. I hope you have a great rest of your day out in California. Enjoy the sunny weather.
Thank you for having me, and I will.